transactions. So those of you who are in business are going to be affected by this. It affects you if there is a domestic transaction. Of course, there are categories of transactions which should be covered, but if the value of those transactions exceeds 5 crores for the financial year 2012-13, then you would be affected by this. Transfer pricing provision, basically, in simple language, what it means is that if you enter into a transaction with a related party, it should not be misused to avoid tax or to reduce your tax liability. So if I am buying something from my brother for 100 rupees and whereas in the open market he is selling for 80 rupees, then obviously I am overpaying to my own brother, and to that extent when I give that inflated purchase price in my books of accounts, I will be reducing my profit. So the transfer pricing provisions basically are aimed at curbing that practice of overcharging, undercharging, etc. In case of transactions with related parties. Presently, as I mentioned, it is affecting only international transactions. Going forward from next year, it will affect domestic transactions. Very dangerous provision because it opens up a whole lot of avenues for the tax officers to start, blackmailing the taxpayers, start demanding, I mean, I don't need to say anything more, but it's going to create a lot of problems for the business community. Tax deducted at source, TDS. It's been my favorite here. Whenever I have spoken, I have criticized this, and one more provision has come now on TDS from sale of property, sale of immovable property. So the whole objective is to curb black money. So because people are not paying taxes on the capital gains earned on sale of properties, so government said we'll start collecting tax at source, which is okay. So what they propose is that when someone is buying an immovable property other than agricultural land and the value exceeds a particular limit, which is 50 lakhs in case of some 12 or 13 cities which are listed, Bombay is one of them, or 20 lakhs in the case of other cities, then the buyer, whoever is buying the property, has to deduct tax at 1% of the price and pay that amount to the government. That's fine. All this is also okay. But the problem is, there are two problems. One is the 50 lakhs or 20 lakhs, whatever is the, as the case may be, the limit is applied not necessarily to your transaction value, but to the stamp duty value. So, you are aware in Mumbai, you have all kinds of funny ready reckoners where a property in Dadar may actually be selling for, say, 50 lakhs, but stamp duty people say, no, it is worth 70 lakhs. So the ready reckoner rates are in many cases far-fetched and differing from the reality. So it is provided that where the stamp duty value is higher than the agreement value, then the TDS will be on the basis of the stamp duty value. So for example, you are buying a property for 50 lakhs, the stamp duty value is 70 lakhs, you need to deduct 1% of 70 lakhs and pay to the government, and that the proof of that payment, the challan, has to be submitted to the registrar at the time of registering or offering for registration the document. So obviously when you are buying a property, you will lodge it for registration. The registrar will not register it unless you give him proof of the tax payment. So this is going to be a headache. It's added compliance work for normal people, but it will be applicable to every category of person buying any immovable property, individuals, HUFs, anyone. It applies to transactions entered into from 1st October 2012 onwards. The only silver lining is that some of you may be aware that in the TDS case, when you are a deductor, you need to apply for a TAN, TDS number, you need to file TDS returns, you need to issue TDS certificate, etc. Those responsibilities have not been cast upon this kind of TDS. So that is the only good part about this, that you need to only have one challan. The challan will contain your name, your PAN, it will contain the seller's name, the seller's PAN and the amount paid, and that's the end of the matter. So much for the TDS on properties. Those of you who are directors and receiving director sitting fees from board fees from the companies, there was a question mark as to whether it is subject to TDS. It is now very clear that it is subject to TDS at 10%. those who have the misfortune of being tax deductors would know that if you fail for any reason in deducting any tax, then you are considered as an assessee in default. And the implications of being considered as an assessee in default are manifold. You need to pay interest, you need to pay penalty, and worst is that a whole expense gets disallowed in your business income, you know. So, one positive proposal in the budget is that in this kind of a situation where the deductor has not deducted tax for any reason, if he is able to prove that the deductee, the other party, has paid the tax on this particular transaction, then the deductor will not be considered, or rather the payer of the income will not be considered as an assessee in default, and the consequences will therefore not follow. So the most important is that the disallowance of that expense which was happening in the hands of the payer will not happen if he is able to prove that ultimately the tax is paid. This is a good welcome amendment. But at the same time, the penal provisions for non-furnishing of TDS statement, etc., inaccurate particulars, all that have been made more stringent. And simultaneously, if you have a problem with any TDS order passed by a TDS ITO, then you can file an appeal against that order, which was not there at present. Some other provisions: if anybody has any assets outside India, a bank account, shares, mutual funds, whatever, that person needs to file a tax return in India. And even if there is no taxable income in India, and this also covers any person who is merely a signatory to a bank account outside India. So you may be doing a good deed to some relative who has a bank account somewhere, and you say, okay, I will be a signatory, I know I am never going to sign, but for security reasons, for some emergency, my signature may come in handy, and you agree to be a signatory. And if the government comes to know about it with the help of the exchange of information agreements between any country and Indian government, then they will ask you whether you have filed your return or not. If you have not filed, you are in trouble. And those who have such assets outside India, their assessments can be reopened up to 16 years. So the government can go back into history 16 years as compared to the existing 6 years. But this is bad because, today all clients come to us asking how, which years papers can we destroy. So we were saying 6 years, now 16 years, so we'll have to create godowns to store our papers and all that. It's a headache